All right, so today is Thursday. Daily chart on the left, 1 minute chart on the right. So we have this premium wick highlighted with these gradient levels. We have a buy side imbalance, sell side inefficiency, fair value gap with the gradient levels added to it as well. Then we have a buy side imbalance, sell side inefficiency, BISI, fair value gap there as well. And then we have a discount wick with gradient levels on it. So as I mentioned on this day here, that we were entering a time when an intermediate term high should form in NASDAQ. And I think by anyone's standard, that would be considered an intermediate term high. Look here, regular trading hours, 9:30 starting. Okay, the market breaks down. We have a fair value gap there. We'll look at that in a moment. Another fair value gap there. Small consolidation and drops down into the blue buy side imbalance, sell side efficiency, fair value gap. This line here is this level here, which is the upper quadrant of this discount wick. You see that? So, and it's also very close in proximity to what would be the lower quadrant, but it doesn't quite get there. So if you put your fib on, you'll see that it doesn't quite get to it, but it got real close to it. So if you're grading the fair value gap itself from this candle's low and this candle's high, you would see that it got real close, but did not trade to it, but the upper quadrant of the discount wick, it did. So which one's going to be easier to get to? This one. Okay, and price did in fact trade down into it here. Comes back up, trades to the high of that discount wick at 24,502. You see that here? It trades back down to the upper quadrant of the discount wick, that level right here of this wick, and price starts to rally. Okay. We can see the reactions off of these levels here, which is not a pivot point. It's not any kind of retail logic. It's not classic support and resistance. Okay, but it allows you to look at wicks in the same vein as I do with inefficiencies and or gaps. So the market rallies up, trades back inside the green buy side imbalance, sell side efficiency, and trades up to the lower quadrant of it here, and then to consequent encroachment, upper quadrant, and all the way. Look at the body respecting the perfect delivery of that close is right on the 24,655 high of that bullish fair value gap right there, which is that candle's low. That's beautiful. And then it drops back down just below consequent encroachment. One more time, hammers the upper level of that fair value gap on the daily chart. Once more, trades lower, immediate rebalance here, and rallies up. First presented fair value gap, you can see, forms here. Here's 9:30, and the first inefficiency is there. Okay, so nice displacement, very obvious, and it's a sell side imbalance, buy side inefficiency. So when I annotate its first presented fair value gap in the form of a bearish fair value gap. Why? Because it's a down close candle. Trades up into it here, just falls short of consequent encroachment, breaks lower, institutional order flow entry drill, and let's extend that first presented fair value gap. You can see that we have an order block down here. It's bullish, changes state of delivery after it trades into that upper quadrant of that discount wick. Here, there it is on the 1 minute chart. It retrades back down to that order block there. The body's respecting it, sends it higher. Institutional order flow entry drill here. And now, because price trades above the first presented fair value gap and we're trading consequent encroachment, it's a SIPI at first. So it's going to change its character to what? Now it's a bullish scenario. So we would look for this to act as what? Discount sensitivity. If it's going to trade down to consequent encroachment, it should not trade to the lower half. It does, in fact, do the very thing here. So that's the logic I've been teaching you. Rallies up, creates a buy side imbalance, sell side efficiency. And here, sets another bullish fair value gap, leaves a small portion open, rallies up, does all the business we talked about here. But now we'll put the gradient levels on there, and you can see how it was respecting a lot of those levels as well. And we're going to need to take that fair value gap and extend it forward, so that way we can keep track of what we're referencing when I move forward in time. The first presented fair value gap resumes being a bearish fair value gap once we trade down below it and hits the consequent encroachment and breaks outside of it. That means it's likely to trade lower. Where does it trade to? Inversion fair value gap. Inside this low, we have an order block. which is these two consecutive down close candles. And then we have the little gap right there, extended through the candle. That's why we're not supply and demand. And the bodies respect that beautiful delivery and sends it right back up into the upper fair value gap here. This gap, when it was formed, was a BISSY. So it was an up close candle, fair value gap. That means it's likely to be bullish. You can see it being utilized here. But when we trade down through it and come back up and then fall back down through it again, the upper half needs to be disregarded. In other words, only sensitivity at the consequent encroachment level or below it. And we can see that being shown here. And then it's stacked right on top of first percent to fair value gap, now resuming its bearish initial creation, which is city, down close candle. So now it trades at the consequent encroachment there, breaks lower, breaks aggressively lower into that inversion fair value gap. And then look at the strong reaction off of that. Look at that. So we're going to scrub forward. There's that inversion fair value gap. It rallies up. Now the first percent fair value gap changes character once more. The bodies are respecting consequent encroachment. The wicks are allowed to do the damage. Comes back up, hits it here, rallies up. Upper quadrant of the previous fair value gap that was above first percent fair value gap, and trades up into the upper quadrant of the fair value gap over here. That's what we're seeing here. Back down into bullish fair value gap and consolidates into the close. So I tried to keep the annotations in the PD arrays kind of like short and sweet and focusing on the relationships of the first percent of fair value gap and the other fair value gaps, how they change their characteristic intraday. So as the ebb and flow of price delivery above and below these fair value gaps, it allows you to switch your short-term bias to where the next pool of liquidity would reach for or the next inefficiency above or below. But having the understanding of when these form and how you're looking for price to draw to very specific levels, it helps build your tape reading repertoire. So it gives you a skill set that will increase over time. In closing, I want you to think about how we dove down pretty deep into this fair value gap, and tomorrow's Friday. So the range of Thursday was pretty significant. So in my opinion, I would keep my expectations very low for tomorrow because it's already done enough. You know, if all we had to do was anticipate what we anticipated this week for NASDAQ and it delivered like this, whatever it did on Friday, tomorrow's trading, who cares? You know, it doesn't make a difference because this was such a wonderful display of prowess, being able to understand what the market should and shouldn't do, and the sensitivity and precision of the concepts I'm sharing with you. Well, lo and behold, look at that. So I mentioned last week that I was bullish on dollar unless we were to trade below the daily consequent encroachment of this inversion fair value gap that was given to you before the actual formation of it. The nice rally off of that we've had in the last 2 days has traded above the premium wick in here, above the gap in here, and then up into these highs here. Okay, so I'm going to show you two of them that you need to have on your chart. The first one, when we were down here and trading up, it's always, you know, this swing high. It's, you know, you got to look at that, obviously. But this high has the longest wick. So that's a premium wick. So you can put your gradient levels on that from the candlestick open to the high. That's what's on here. And let me just toss it in real quick. Okay, so on the right-hand side, we have the 5-minute chart. Again, the left-hand side is the daily chart. And at midnight, price is consolidating and traded on the low at 97.786. That's this here. It's the low of this premium wick. So we opened, traded down, had a little bit of a Judas swing, and then we found some support right at that level again here. London Open kind of was like really not all that eventful, but no, the New York session, New York Open, had a lot of animation. We had a breakaway gap in here, just kept on ripping higher. And then we have a fair value gap there, right on the lower quadrant of this premium wick. That's this level right here. Fair value gap right at the quadrant level, another little fair value gap so you can get in a pyramid, okay? And then rallies strongly off of that. Which creates a retracement lower, fair value gap, and then we have a volume imbalance. It's really tight to see in here, but you know, in your chart, you'll be able to see it easily. The buys respect the bullish fair value gap here. We have a measuring gap that stays open. So breakaway, measuring gap, and then fair value gap, bullish breaker. So I have a swing low here and a lower low. So that high here, bullish breaker, trades into it here, bullish fair value gap, rallies through, bullish fair value gap once more, trades up to the lower quadrant of, that's this level here. That's the lower quadrant of this premium wick. London close is, it's an extended window of time, goes from 10 o'clock in the morning Eastern time to as much as 1 o'clock in the afternoon. That's kind of like the latest portion in the day of the New York session, PM session, that I'd be concerned about. So obviously it goes a little bit further than that today because it's such a big blow off type run. So we're reaching for the buy side here and the upper half of that premium wick, and then we'll look at this one in a moment. So now I have the fib ran across this premium wick, and these levels here you can see are much more pertinent once we get into the 98.24.5 level. That's this here. Look how the buy respects it there. The candlesticks are respecting that level there. And we drew right back down into that. So we have upper quadrant there, which will be that, and then the high. So what are these right here? Relative equal highs, right? Isn't qualified by having a lower one to the right than that one here? Yes. So buy side sitting at 98.73.3. That's in striking distance for dollar index. All right, euro dollar. This baby just fell right out of bed, didn't it? Inversion fair value gap, we covered that the other day. Then we have a gap here, which is a bullish fair value gap, but this changes its state to a premium array. So it's going to be what? It changes from a BISI that would be bullish once it trades down into it like it did here. But if it trades down through it like it did yesterday, this becomes an inversion fair value gap. Okay, so it's going to act as a reversal of what we expected. All right, so the market creates this run up into here. London kill zone, again, like in dollar index, was kind of like lethargic, wasn't doing all that much. And then New York session, we came alive. We had a breakaway gap, bearish fair value gap. We trade up into that. There's your Judas swing during the New York session. Break lower. Order block that's bearish, change in the state of delivery. These candlesticks here that open. Big precipitous drop. Lower, trades down into the discount wick of this candlestick here. You can see it at 1.16945. That's this level right here. And it creates a measuring gap and a breaker. So we have swing high, low, higher high. That's a bearish breaker. We trade up into it several times. Look at the wicks. This will allow to do the damage. And then we break lower. We have a small little fair value gap. That's not enough room for me to annotate, but it would be a bearish fair value gap there. And we have an inversion fair value gap there. Trades up into it there perfectly, and then drops lower into the London close, trading below the low of that discount wick. Now I'm going to show you this discount wick where I believe that we may be requiring attention to. So these levels here, you want to have them on your chart as well. You can look at this one here, the longest one, lower, but don't disregard this one. It's important you have that one, okay? All right, pound dollar or cable, same thing here. We had a bearish fair value gap delivered from yesterday, and then the discount wick here, and then we have a discount wick there, and then we have a bullish fair value gap it traded down to, and I put the gradient levels on the bullish fair value gap. So just to pay attention, what we're looking at over here. This is the daily range for today on Thursday. You can see how we traded up into the upper quadrant of this one here at 1.34650, right there. Fair value gap trades up and body's respecting it, and it's also the lower quadrant of that count wick. We break lower after another return up in with that fair value gap. Then we have a breakaway gap. Fair value gap, trade up into it there, which is institutional order flow entry drill, and it happens to land directly on consequent encroachment of this discount wick. Breaks aggressively. Now we have a measuring gap about halfway what we're expecting to trade down to that bullish fair value gap over here. Trades into a SIBI, which is a bearish fair value gap there. Discount wick, graded that, trades up into that. shoots it with the wick only, not the body, into this bearish fair value gap. And we have a small little fair value gap there. Body's respecting it. Wicks are allowed to trade outside of it. And then we have another little fair value gap there. Digs into that bullish fair value gap in blue. And then the bodies respect this fair value gap and it sells off and trades just short right before it gets to that little low down here. So it was like 1 tick or so away from that. That's very, very close for government work, right? So you can see how having an understanding of reading gaps that are viewed in your candlestick as a wick above or below a candlestick. If you're going to look at candlesticks, this is the real science behind it, because you can really read real institutional order flow, real order flow, and you don't need to worry about how many contracts somebody wants to buy or sell above or below the marketplace, because the number of those contracts absolutely has no bearing on where the market's going to go. Zero. It has zero bearing on how the market's going to go. You need to know where it's likely to reach for in a direction, and then look for key levels like this, like I'm teaching you here. Over the last 2 weeks, I've given you insights about reading price action that nobody on this planet has ever talked about. And you can see how it overlaps with my PD arrays, like perfectly. And by having that overlapping and confluence, it just makes the PD arrays stand out on your chart. And that means that you know which ones to use now going forward.